Hi everyone, I'm Michael Heath. I'm Bloomberg's economics reporter in Australia. I might kick off with Sally, if that's okay, just to give us an overview of Asia or of the global situation, which looks like it's heading into a bit of a difficult period. Industrial output in South Korea and Japan a bit weaker than expected. China's economy is slowing, obviously just as tariffs are biting. India's been going gangbusters, but higher oil price, bit of emerging market turmoil has exposed a few issues there. Asia, particularly China, has proven resilient in the past. Can it power out of this situation now? What's your take?
It's a good question. I mean, that was a very good summary, I guess, of where we find ourselves today, which, yesterday we did have quite a bit of weak data across the region, Japan, Korea, Taiwan, also China as well. And, sometimes if you're sort of monitoring the high-frequency data in Asia, it does get impacted by the ups and downs in the tech cycle, and we seem to be in the midst of that at the moment. But I think in the back of our minds at JP Morgan, there has always been this sense that the risks around what's happened with trade wars and the way that was going to play out in Asia was always to the downside. And trade wars, I mean, they're sort of largely unprecedented in the last couple of decades, at least on this scale. And from an economic perspective, when you sit there with the spreadsheet in front of you and try to work out, well, what does this mean for growth? What does it mean for inflation? You end up not getting very big changes to growth and inflation forecasts. So, at JP Morgan, our view is that effectively the US will move to implement 25% on all Chinese exports to the US, and that'll probably be a story for the first quarter of next year. And when we run the numbers, we didn't really make sort of huge downward revisions to growth anywhere except for China, where we sort of argue that the trade wars probably take off a percentage point on growth, but we feel like you get 7/10 of that back through a lower currency, fiscal stimulus, some RRR cuts. We've had a couple of those already. And so on net, you get slower growth in China, but it's not a disaster. Now, we've always said along the way that even though the big sort of macro aggregates don't change, what we're going to be keeping a really keen eye on is how business sentiment is transpiring globally. And you can look at, the data you get gives you, how good a business is feeling right now. And they also give you a series on how good a business is feeling about the future, so expectations. And what we're starting to observe is that, for now, things are holding up quite nicely, but the expectations index, what people think about how things are going to be in the future, is starting to come off. And for us, that's worrying. That was always going to be the bellwether indicator that was going to tell us whether this trade war story had the potential to turn into something a little bit more sinister for the global growth story. So, as a bank, our forecasts on global growth are still reasonably positive. They're for above trend growth. But what I would say has changed in the last couple of weeks is the risk bias to those forecasts. So we're now articulating that, well, we've got these numbers, but we're worried that if we're going to be wrong, it's because our numbers are too optimistic. And I think yesterday's data, even if you try and sort of take out the effects of the tech cycle, are probably pretty sympathetic with that view. So I hope that we're wrong, but to the extent that Asia is highly leveraged to global trade, highly leveraged to manufacturing, and that's really where the weakness has been in the third quarter. It's been in industrial production and goods production. Maybe the forward signs for Asia are a little bit more shaky than perhaps we'd like them to be.
Ms. Bowen, you might not like this, but the polls suggest you'll be the next Treasurer of Australia. Or maybe you will like it. It's obviously a complicated time in the region. I mean, how would a shortened government address Asia? I mean, what are your priorities? Obviously, there's been tensions in the relationship with China. A lot of people would argue that Australia hasn't made the most of potential relationship with India. We obviously have terrific diasporas with those two countries, a lot of talent there as well. Can you sort of speak to those issues?
Sure. I should say at the outset that there's a long way to go and we're not getting ahead of ourselves. But our approach could be taken in a few different compartments. We've announced our Future Asia Framework, which has much deeper economic engagement with the various parts of Asia very much at its core. We've announced various policies underneath that, which go to the diaspora, which go to literacy, and a much bigger focus on language literacy in early years to feed through to universities, better engagement, 2+2 finance and trade with Indonesia, for example, a whole range of policies of which we'll announce some more tomorrow. each policy in and of itself is not a world beater, but you add them all together, and there's now a very substantial body of them, and there'll be more. I think you have quite a substantial step change in the level of engagement from the cabinet and from the government in deeper economic engagement. We think we've paid Asian lip service we've paid the Asian century lip service. We talk about it, but there's been very little leadership, frankly. I'm not making a partisan comment, but since the Ken Henry white paper was in effect shelved, it's been removed from the website, archived, which is a great pity. We've seen very little engagement. On too many occasions, incoming governments have just scrapped things like the Henry Report because they weren't their idea. We won't do that. For example, the new Colombo plan, we think is a good initiative, and where things are working, we'll continue with them. But we will very much lift the level of engagement from the Prime Minister down. Penny Wong and I are deeply committed to this. Joe Sinclair, we've all been involved in announcing future Asia policies. Jason and I announced a whole range in relation to India recently. We would adopt in principle the Varghese report, lock, stock and barrel, which the government hasn't done. We think it's an excellent report. We commend the government for instigating it. We just wish it would be implemented, etc. On the issue of navigating the shoals of geopolitics and China in particular, frankly, you would find very little policy difference between us and the incumbent government on matters of detail. South China Sea, other matters, you would find very, very little difference. What you would find is a difference of subtlety and nuance and communication. I think far too much the relationship with China has been dragged through the Australian domestic political debate, which is hardly conducive to the nuance required. In my experience, I was in China a few weeks ago. China understands and accepts that there's going to be differences completely. What they are perplexed about at very senior levels is the lack of what they see, understandably, is a lack of respect, a lack of subtlety in our public communications. Lecturing, you're saying Australia has stood up in Mandarin is not really conducive to an understanding of the nuances of difference. So I think obviously Bill made his foreign policy speech earlier in the week, talking about his foreign policy with an Australian accent. The difference is primarily one of communications and nuance to handle a nuanced relationship. I mean, this is the first time in our history as a country that our key trading partner is not our key geopolitical ally. From 1788 onwards until 2006, it was the United Kingdom and the United States, with Japan as our largest trading partner for a period, but that was okay because they were in keeping with our geopolitical ally, the United States. From 2006 onwards, our key ally is not our largest trading partner, to start with by a small margin, and then, of course, over the last decade and a half by an expanding margin. So now by many multiples, China is our largest trading partner. And for the first time, cabinets have faced that conundrum, and we will, just as the Abbott and Turnbull and Morrison governments have faced that conundrum. But it's a conundrum best faced with a clear-eyed view of our national interest, of course, but with a view to how things can be communicated more subtly than they have been over the last year or so.
Speaking of the US, Heather, I'll bring you in there. Clearly it's booming, and the Trump administration's decision to pour fiscal stimulus onto an economy at full employment perplexed a few people. No doubt it's terrific in the short term, but surely the risk now is an inflation breakout in the US, the Fed slamming on the brakes, and the possibility of a hard landing. If that is the case, I mean, what then does that mean for us and for the region as well?
Look, I think most people, and I was recently in the US at the Bloomberg conference actually, and I had a number of meetings in New York, and the overwhelming consensus seems to be that we'll have a recession in the US in 12 months to 18 months' time. And because so many people are of that view, I worry a lot about it. When every parrot in the pet shop, to use someone's old expression, is saying this, you worry about it. And I think we've seen a lot of volatility recently in markets. And going to Sally's point, I think there is a bit of a turning point, and a lot of serious people are starting to worry, because even in the recent corrections we've seen in markets, some of that is caused by what the Fed might do, and the market's reflecting it, and those rising bond yields, the flattening of the curve, all of that is really predicting action by the Fed. Now, I think there's every possibility that the Fed will overshoot on this. And there's a lot of argument that the Fed could almost stop now because the long lags in monetary policy, 18 months to 2 years, they're going to be, a lot of these increases in rates that they're pouring, and they've already done it, that they will put in over the next 12 months, and I think they will put quite a few in. They won't be cutting in for some time. But when you look at a US economy headed for, in some people's view, 3.2% unemployment, I mean, that is just ground that we never ever thought we'd see. And and there's always been this debate in the Fed that they've been behind the curve, that they've allowed the economy to grow. And Janet Yellen was a labour market economist. She strongly believed in looking at the labour market, and that's taken some time. But now there's a new guy in charge. There's a new feeling of nervousness, and the US economy is pretty hot. And I think that the stimulus, huge earnings stimulus that Donald Trump's, fiscal stimulus threw into an already stimulated economy. We had, plenty of accommodatory room in monetary policy. It's still there. It was bordering probably on reckless. So my feeling is the US economy, the Fed will tighten. I think next year is going to be a very volatile issue. I think people are going to be handling portfolios with late cycle characteristics and all the tailwinds that come, and the kind of worries that come in that. And I think in Europe, in Asia, the US dollar strengthening, rising interest rates, the trade wars, given the Melbourne Cup on Tuesday, it's a pretty tough trifecta in Asia. It's been traditionally so. But at the same time, I don't think, the GFC was a very brutal crisis. And, Brett, what will the US downturn look like? What would a Fed brought-on recession look like? It doesn't have to, and it will not look like the GFC. But we do have these unusual characteristics of this trade war, which is unpredictable, and we always make things worse for ourselves, and I suspect that is going to make things potentially worse than they otherwise would have been. For Australia, we're not in bad shape. The economy is going to get stronger before it gets weaker. We've still got slack in our labour market. The Reserve Bank is clearly in no hurry to put up rates. We have low government debt compared to others, even though people wring their hands about it. We've got well-positioned banks that don't rely as much as they used to on foreign borrowing. We have $2.7 trillion in superannuation assets. So, we're not in a bad place, but it's going to be not going to be the story of the past. And the other comment I'd make is that the US is a bit of a standout in the world. The US is really strong and everybody else is easing, and that is an odd position and something to we have to think about.
Well, let's address the 800-pound gorilla in the room, China-US trade war. What are the scenarios for the future? I want to come to each of you on this. What are the scenarios for the future in terms of escalation? And a lot of people argue that, Australia is not impacted directly because our exports are for domestic Chinese use, but surely a slowdown is going to be a slowdown in the economy is going to be a serious problem for Australia. Ninan, I might begin with you on what you sort of see as scenarios unfolding with the trade war. Does it continue to escalate? Where do we go from here?
From the Indian point of view?
Sure.
Well, they've done some studies, I think, preliminary numbers to see how much the impact would be, and I'm not sure there will be very much. Mm-hmm. There will be some opportunities that will open up, but I doubt if there would be a huge impact. As it is, our exports are pretty flat. So there will be some opportunities in areas like selling soybean to China and some products to the US, but not a huge impact.
Mm-hmm. As Sally, you mentioned that it's basically the confidence challenge channels that it comes through, telescoping that sort of forward, as the governor would say. Escalation seems to be where we're headed towards.
That's our base case at JP Morgan, that we will get another round of the tariffs. And I think we feel at the moment there's been, earlier in the year there was some uncertainty about whether this was a desire of the US administration to be aggressive on trade with all major trading partners. And I think, we've learnt over perhaps the last couple of months that there's a bit more of we've got NAFTA Mark II done, so we can be a little bit calmer about that. There seems to be a bit of a detente with Europe, and Japan and the US appear to be negotiating about trade in a constructive fashion. So from that perspective, that's a good thing, but it does really mean that the focus appears to be on China. And I guess you would argue that this is only one pillar of a broader strategy, which appears to be sort of this decoupling between the US and China on a number of fronts. So that will matter for Australia. I mean, we're a small open economy. We're highly leveraged to trade. So in a world where trade becomes more difficult, that in itself is not a good thing for us. We might be a little bit protected in the sense, as you mentioned before, that most of our major exports to China aren't inputs into the things that have had tariffs put on them, and that is some comfort. But I think in a broad sense, we still are reasonably vulnerable to overall growth rates in China, and also the composition of growth in China too. And so, the trade war is one thing, but I think for us, we need to think about the Chinese ambition to, effectively restructure their economy away from, externally led growth, more to domestic demand, and think about what that might mean for our export complex and the way we position ourselves, in the medium term. So, I agree with Heather. Everyone sort of talks about a recession in the US in late 2020. I think it's the right way to think about it, to say that when it does happen, it will look and feel more like a vanilla US recession as opposed to something as severe as 08, 09. But I think it'll be hard for Australia to sort of duck and weave the next global slowdown. As we know, we haven't had a recession for 27 years. So there's a good chunk of the Australian population, who don't know what it's like to experience a recession. I was just started university when the last recession had happened, and so if I sort of think, I have some sort of distant memories of what it was like. Luckily, I wasn't in the job market, but pretty much anyone younger than me, and that's 60% of the Australian population, would have no adult memory of the last recession. So I think we need to be mindful of that. And we need to be mindful of the fact, as we know, debt levels are elevated in the household sector. And the one thing that will be different this time around relative to 08, 09 is that China will not be doing a 7% of GDP fiscal stimulus. And that made a big difference to Australia in the global financial crisis. So they are far more constrained in their policy options now than they ever have been. And so we will have to battle that global slowdown, on our own. And we've got some positives. We've got scope for big fiscal stimulus. We've got a little bit more room on monetary policy. Currency's probably got scope to come lower if need be. So, it won't be a complete disaster, but, my sense is, thinking about the contours of the next downturn here, it'll probably feel pretty nasty, I think.
Chris Bowen, I mean, Australia, you did allude to it as well. Australia's surely the meat in the sandwich here. As the most China-dependent developed economy and one of the US's staunchest allies, we obviously can't take sides in this situation, but, I mean, what is the path to navigating between them?
Well, I mean, it will frankly largely be out of our hands. We can provide friendly advice. That's as far as it'll go. And, I frankly am at the more pessimistic end of the scale if the current trade skirmish turns to a full-on trade war, as is a very real risk. I'm at the more pessimistic end of the scale about what that means. I accept the sort of direct impacts, but I'm a little more worried about the animal spirits, both in Australia and elsewhere, and the confidence impacts, which I suspect, given it is on everybody's lips, I think it could be worse than we might hope. I'd rather not find out, but that's really out of our hands. I mean, I think from an Australian point of view, we could observe that the United States does have some legitimate issues. There have been issues that have been on the table for 15 years or more, longer, and the United States has been asking, requesting, begging, demanding some of these things for 15 years, and that should be recognised. Now, there's a much better pathway through than the one that's currently being proposed to deal with it, And you know, we can say that as the largest trading, with China as our largest trading partner, we can say as observers that there are issues that are legitimate to be discussed and addressed, and for China to make progress on. But a trade war is in nobody's best interest. We shouldn't pretend. We shouldn't rely on the hope that it's not going to be too bad, because I fear that the ramifications could be significant.
I'd only add to that, and I'm a bit more in Chris's camp, I think, as well. I think it's the combination of the trade war in an environment of rising US interest rates and world interest rates. So you amplify the effects of it. Also, if things got tough, I mean, China has been stimulating, and that stimulus, it's got lags attached to it too, so it's not actually delivering much yet. But, you know, that's really to compensate for the trade stuff, not to be a net positive for global growth or for Australian demand. So I just worry that we could be caught also in any rapprochement between China and the US. What would that look like? There have been talks of deals that have been discussed with the Chinese and Americans, which Australia would be a net loser from. These second round effects. So I think, you know, Australia is an open trading nation. We're the most open economy in the Western world, have been for a long time. Organisations like I used to represent opened up manufacturing in Australia to it. Chris was around, we had lots of discussions about it. So we've gained from trade, and we have everything to lose from this system. I'd make one comment about the WTO, and I think one of the real frustrations, and again, having been around this space for a long time, these institutions need to be reformed too. They need to take account of new players in them. They need to take account of China. They need to take account of India. I mean, I was at the WTO and the Uruguay round, and I know where you guys sat for good reason. And so I think the real movers, Europeans and the Americans in the WTO, in the IMF, they've been very slow to reform these institutions and allow new people in. And in the end, they'll go off and form their own, or they'll just won't abide by the rules, or they'll say we're abiding by the rules when they're not abiding by the rules, and those who say they are abiding by the rules don't abide by the rules. So you get this kind of either, as one of the earlier speakers said, lack of respect, disintegration, or something, which might be the least worst option, might be something. So I think, and even with the digital economy that's emerging, this is not really covered by the WTO. So these institutions need to have a really good hard look at themselves. And I think one thing Australia can do, because we're really good in that space and always have been, top players in these world institutions, to get in and say, we want to be part of, remember the group we used to be with you guys, you know, to actually refresh and reboot these institutions. And I think that'll be the way to peace, not conflict. And
because I think, you know, if we don't do that, then it might sound extreme, but we'll end up in a world that has two trading blocks, two payment systems, and two internets.
Exactly, and a technology that's going to break down all that. So people will lose control of the movement of money. I mean, I'm sort of looking over some of these blockchain technologies, and it's intriguing. And the technology will start to get ahead of these institutions, and it already is. And so
I
it's a big issue.
Bring in our poll now, just to bring a bit of audience participation, which if you log on, you can vote in. And again, it is on the Australia, the impact on Australia of US China trade war continuing to escalate. Obviously, the three choices of the impact would be Australia comes out unscathed, limited damage, or catastrophic. So we'll see how that goes. In the meantime, Ninan, I want to come back to you. India's been the world's fastest growing economy for a few years. And from a distance, it certainly looked as though it's beginning to fulfil that potential that sort of everybody believes that India has. Now, where do we stand in terms of the Modi reform plan? We've obviously got an election coming up. It was presumably going to be impossible for him to meet the expectations. You know, there's such huge expectation when he came in. But how would you say things stand in terms of his economic reform plan and what's ahead there as well? Can we expect much from the government there?
The government's continued to function, but is in election mode. He's done a fair amount, but in his campaign in 2014, he had clearly overpromised. And from the standpoint of what he talked about doing, it hasn't happened. I mean, he said he would take growth up to double digits, 10%, and all we've managed is to stay where we were. But he's done a great amount, and he's also, it's significant that he's deepened markets and got them to reach down into levels of, I think instead of being just stuck at the top, in terms of penetration of the financial system and banking sector. The way he's reached goods like cooking gas into almost every home. His effort to build toilets for universal coverage of the population, which didn't exist. So he's rolled them all out in a sort of ambitious, big target way. He multiplied fivefold the target for solar energy installation. And he put the numbers out in front, and he went after them, and it looks as though he might achieve the solar energy target. But clearly there is disappointment. The demonetization didn't help. The introduction of the GST is significant, but it's been a little messy. So farmers are upset with some of their policies. Small businesses are upset. So the general thing, even opinion polls show, is that the government has lost ground in terms of support. But Mr. Modi himself remains by far the most popular politician with an enormous public support. So the question is, when it comes to the election, will people vote for him or in relation to what the government has done? And in any case, the opposition is relatively weak, and if it can't come together, it's not going to displace him. So the general betting is that he'll come back, but he won't have a majority. He will come down to a minority, so he'll have to go back into a seated coalition.
Okay. If we come to Australia, Heather, how appealing are we to the region? I mean, you mentioned our strong growth, but the reality is that 1.5 percentage points of that's immigration, 1 percentage point is commodity exports, some household spending on top, and other things as well. Obviously, there hasn't been a lot of drive out of governments over the past decade or so in terms of an economic narrative. I mean, how can Australia increase its attractiveness to Asia? What would be the Ridout plan there?
There isn't one. Well, I think the absolute the centre of the plan would be try. I think Australian business needs to try harder in the region, and I think we've been pulling back from the region, and there's plenty of examples of it. So I think Australian businesses need to have that much more as part of their strategy. If they've got a 5-point plan, one of those points has to be strengthening our engagement in Asia, and we have not been doing it. And I've been involved in Asia Link for years, a great organisation, Asia Society, and we do all this good work, but then we don't have enough high-profile engagement in Asia. And so, but at the same time, in funds like mine, we invest $2 billion in China, mainly in big stocks. We have $3 billion in Japan. We compete because there's so much capital in the region that has its own capital, Temasek, all of these characters. I mean, they really don't need Australian super's money. We end up in competition with them, and it's much easier to go into places like Europe or the States where it's a more benign place for us in many, many ways. But China is Australian super's identified as one of our growth regions for 2019. We have an office there. We've had one for many years, only an office to develop relationships and understand, and it's been very patient capital on behalf of the fund. It's really the only overseas office we've had until a year or so ago when we opened one in London. So we sort of instinctively understand the importance of it, but I think Australian business and the Australian government position in the area, I think it's been a bit blunt in recent times, and certainly China's changed, but so has the US changed, and we've been caught, as Chris says, sort of a bit in the meat and the sandwich, in that maybe we should be seeing them not through the prism of our enemy, but as through deal with them in a way that's based on the actions that they take, rather than have some overwhelming view about how we're going to be an ally of America. So I sort of think Australian business needs to take some risk in the region, but it's not going to be an easy environment to do it in over the next few years, because it's going to be tougher. It's going to be much more unpredictable. The next 12 months are going to be volatile. And as I said, the volatility is not just going to come from the vanilla bread and butter US Fed-driven taking away at the punch bowl. It's going to be driven by these two very unusual personalities. I call them unorthodox personalities, sort of conducting this modern-day Cold War, which no one wants. The Cold War was, John le Carré and everything done without the internet and people knowing what's going on. Everyone knows what's going on these days, and it's just a very outdated, blunt way of looking at geopolitics.
Chris Bowen, can we compete in Asia beyond mining and the agricultural sectors? I know the answer is yes from you, but
we absolutely have to.
Yes.
It's not an option not to. And I think the big thing here is we can all muse about what's going to happen in the trade war. We'll either be right or wrong. We're all guessing, frankly. We can all muse about China's headline growth rate and the debt levels and whether we're optimists or pessimists. The one thing that's a given, there's no question about it, is that China, primarily, and others have moved from investment to consumption. That's the one fact, the underlying fact that is happening. And of course, whereas Australia has inbuilt advantages in resources, with all due respect to the resources sector, we have a very limited number of competitors. The product at its peak sells itself, frankly, with all due respect to the companies involved, who are all fine professionals. We have no inbuilt competitive advantage necessarily in retail and services. We have to compete against the world. We have great offering, but we don't have the market to ourselves, unlike resources where we just have a small number of competitors. These products are available from absolutely anywhere. So we have to compete on quality, on engagement, on literacy, and at the moment we're not, frankly. We're not. We're just not providing the leadership, the level of interest, the level of engagement necessary, because as a country we're just used to the resources selling themselves, so that's going to end.
We don't have a lot of time left, but Sally, I just wanted to ask you, we've obviously had ultra-loose monetary policy for a long period of time, led to elevated asset prices, and I think in terms of housing, Hong Kong and Singapore are sort of classic examples. We are as well. How do you see that playing out? Everybody's sort of seems to be using macroprudential tools. Things have stopped sort of rising. Can we have soft landings there? And I guess I bring Australia into this as well, that we can unwind things fairly gradually. What's your sense?
Yeah, I think in Australia, we could have a soft landing. Effectively what we're trying to engineer here is a gentle deleveraging of household balance sheets, which is obviously much more preferable than a nasty, violent deleveraging, which tends to happen, when it's forced in a recession. But the problem with doing it in the gentle fashion is that you need a long runway. These things take lots and lots of years. So for us to engineer the soft landing, the best sort of backdrop to that would be sort of steady global growth, and sort of nothing untoward that happens. Now, given the sort of tenor of the conversation today, it sort of feels like that's probably a little bit unlikely. But, that doesn't keep us from hoping that can be the case. So we'll see how we go there. And in a way, I think what the RBA wants is a little bit more incomes growth, which would hasten that process, but not too much, because if we have too much, then you're going to have to start raising rates, and maybe we don't quite want to do that just yet. You're definitely right to say that what we're witnessing right now is a withdrawal of liquidity from the global system. So that's happening because the Fed is hiking rates. It's also happening because they are shrinking the size of their balance sheet. Europeans are about to start a similar sort of process, or at least not grow it as fast as it has been growing. And we think Japan is sort of doing it, but in a sort of funny stealth way. But yes, all that, I think will be meaningful for asset prices, and it will certainly be sort of, difficult in a world where we're less convinced about the robustness of global growth. So, Heather, made a really important point earlier on, which is that, the US is really the only economy that we're sort of convinced is doing really well at the moment. And at JP Morgan, that really wasn't our sort of core view for this year. We thought we'd get a rebalancing of global growth where the US came off sort of highs, but other parts of the world started to lift, Europe in particular, and that's been the massive source of disappointment for us. And we thought, maybe China would do a little bit better as well. So we're sort of left with an uncomfortable situation where global growth seems overly reliant on the US doing well, yet that's the one economy where monetary policy is being tightened. So,
Yes, if I can go on, sorry.
I was just going to say 50% of global stock markets are in the US, so kind of it's very...
yeah, and at the beginning of this week, we had, there's maybe like 20, 25 asset classes that at JP Morgan we sort of track each week. Only 20% of those have delivered returns above cash so far this year in 2018. Now, that's sort of what wasn't meant to happen in 2018. And if you go back and you create a series and say, okay, well, what proportion of markets are delivering, returns above cash in any given year, 20% is basically as bad as it gets. So
had their money in Australian super.
they should have, yeah, that wouldn't be the case. But, the point is that, markets are either massively overreacting on the downside and pricing in a Fed mistake that won't happen or a global recession that won't happen, or they look a little bit cheap. So, in the interest of finishing on a slightly more optimistic note, the JP Morgan view is that, equity markets should do better into year end.
Okay.
So
I think we're just about out of time. So thank you very much. We're sort of done. You got to run. Okay. All right. Well, if you could say thank you very much to our panel. And,